Welcome to Minc Market Education. My name's Stuart McClure and today you're watching the Bull Call and Bear Put Spread webinar. So let's get started. First of all, the Bull Call spread is a bullish market strategy, not extremely bullish when compared to a long call, for example, and I'll explain why in a second. But it basically profits by predicting that a stock will rally over a certain period of time. Now, this strategy is less risk than going out and buying a call because we're capping our potential return. We're selling a call at a higher strike price, which in effect reduces our cost base and therefore lowers our risk. So the actual construction of a bull call spread is to buy a call or a lower strike call and then sell a distant or cheaper call at a higher strike price to cap our potential return and lock ourselves in with a maximum spread. So here we have a chart showing where we would position our strikes if we were placing a bull call spread. You can see here we're going out to purchase a 34.50 December call. This is about 6 months away from the current time. Now, at the same time as placing this bull call, we're also going to sell a 38.50 December call. Now, as I said earlier, this determines our maximum return because maximum profit is the distance between our bought call and sold call. And we do require the stock to rally all the way up to that 38.50 sold call to receive this maximum profit. So you can see here on the chart we're really looking for a bit of a recovery in the stock back up to 38.50. Now, looking at the payoff diagram of this particular strategy, you can see on the bottom left there we always have a capped maximum loss. So what we pay to get into the trade, the cost of setting the trade up, is always our maximum loss on the bull call and bear put spread strategies. And you can see as the stock rallies, our profits continue to increase until we get to the point there where we actually receive a maximum return, and that's at 38.50. Going through the construction of this trade, looking at the break-evens, for example, we just analyse the different points here. We have a high strike or a sold call at 38.50. We have a low strike or a bought call at 34.50. Our entry cost is $1. So to set this trade up, the initial cost of the trade is $1, which means our risk on the trade, our maximum potential loss, is also $1. Our maximum return is calculated by subtracting the cost of the trade from the spread. So $4 is the difference between 38.50 and 34.50 minus the cost. Our maximum return becomes $3. To work out our break-even point, we simply take the low strike or the bought call strike and add the cost of the trade. So $34.50 plus $1 becomes $35.50. Now, to have a look at a little bit more detail of the construction of the actual trade, we really need to try and determine where it is that we're going to put our strike prices. So where are we going to buy the call and where are we going to sell the call? Now, there's a lot of variables that change when we move these strikes up and down, and theta is probably one of the most important, being the sensitivity to time decay. Now, let's have a look at the difference between an in the money and out of the money. Now, the example that we've looked at previously, where we bought a 34.50 when the stock was trading around 34.50, is an out of the money bull call spread because we need the stock to rally up to 38.50 for us to make our maximum profit. When I'm talking about an in the money bull call spread, we might actually be selling a strike around the current share price. So, an in the money bull call spread has a higher probability of success because we don't require the stock to rally, we simply require it to stay still or maybe go down a little. Alright? The next thing to consider is the fact that it has a far less return. Because the probability is higher, your returns are always going to be lower. Okay? The next thing to analyse is time decay. It's actually going to be beneficial because we're selling an at the money. Theta or time decay will actually benefit the strategy when we're doing an in the money bull call spread. An out of the money bull call spread, on the other hand, its probability is lower. The return, because we need to see a significant rally in the share price. The returns are greater because this probability is lower. However, we don't benefit from time decay in this scenario. We actually lose money each day for holding the position. So there's a big difference between where we place these strikes. And what I suggest is you look at the delta, or all of the Greeks really, but particularly the delta and theta when trying to determine where it is that you'll place your particular strike prices, and also consider what sort of time frame you're expecting the stock to take to rally from point A to point B, or perhaps stay still. So that is the bull call spread strategy. Now what we're going to do is have a look at the bear put spread strategy. So now we have the bear put spread strategy. This is a bearish market strategy that profits by predicting a stock will fall in value. It's less risk than going out and simply buying a put, because we're selling a put at the same time, which has two effects. One is to reduce the cost of entry, and number two is to reduce the time decay on the position and therefore reduce the overall risk. To construct the bear put spread strategy, what we're doing is we're buying a put and then simply selling a put at a lower share price. Now, duration for this particular strategy can be anything from 1 month right up to a year or two, or even longer. It simply depends on your outlook on the stock and how long you're thinking it's going to take to get to that particular price. Now, what I want to show you next is here we have a chart of a bear put spread that we've constructed. This particular stock is currently trading at around that $38 mark. What we're going to do is go into the market to buy a $37.50 put out to December, so it's about 5 months out. At the same time, we're going to do this as a tailor-made combination trade, and we're going to sell a $33.50 put at the same time. So as I said earlier, our maximum profit is the distance between these two, or $4, and we're looking for the share price to be trading at or below $33.50. Now, having a look at this next chart, we have the actual payoff diagram for the strategy. So on the top left there, you can see, top left, we've got our maximum profit, which is achieved at or below $33.50. Okay, so this is if the share price falls in value. If the share price remains high or above $37.50, you can see on the bottom right hand corner we've got actually taking our maximum loss, which is capped and limited. Now, important to note that both the top left corner there, our maximum profit is capped and limited at a particular amount, and our maximum loss is capped and limited at a particular amount. So now let's have a look at the returns on the strategy. We have a bought put at $37.50, a sold put at $33.50, a cost or risk of $1, a maximum return, which is calculated by taking the spread between the two, $4, minus the cost of getting in, which is $1, which gives us $3 maximum potential profit. And our break even is calculated by taking our bought put of $37.50 and subtracting the cost. So $37.50 minus $1 gives us a $36.50 break even. Now, as I said, we really want the share price to be at or below this level to at least get our money back for the trade. Preferably, we're aiming for it to be below $33.50. So something to consider in the construction of the trade. I think the first thing you need to do is work out how long it's going to take for it to behave in the way you're expecting. Then analyse, is it worthwhile to us to have a positive or negative theta? So do we want time decay to work for or against us in the position? And then work through the delta to see if you're going to exit the trade early, you want a fairly high delta or a strong delta. If you're going to hold till expiry, then that's less important. So there's a lot of things to consider there. Make sure you watch the webinar on Greeks so that you've got a good understanding of all of those different Greek aspects that we're talking about, and use that to make an informed decision as to which strikes you'll choose on your bull call or bear put spread.